Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant. This is the Smart Property Investment Show as we run up into Chrissy. A lot of madness out there. I think everyone's trying to find property before the end of the calendar year and try and get those goals ticked off that they probably set earlier in the year. What we have seen over the last week or so is a lot of the rhetoric around potential rate reductions into the future looks to be dissipated. A couple of lenders have come out pretty much saying this is essentially the bottom of this easing cycle. So as you go about planning for 2026 and beyond, I wouldn't be factoring in too much in the way of rate reductions. So make sure your maths stands up. Lots about this on smartpropertyinvestment.com.au. Go and tune into it. But all the sort of a lot of the headline economic indicators and also rhetoric from the Reserve Bank is that it's probably going to be steady as she goes for quite some time. So stability in the market is a good thing, sense for the Australian economy. There are some pressures and strains certainly to it. So if interest rate reductions is part of your strategy to try and get into the market or move into different markets, maybe rethink that and probably have a chat with the relevant people as part of your cohort of advisors to support you with that. But we're not here to talk about that today. We're here to talk about how to find markets that you should be investing in. It's Australia's national pastime. He's talking about which market is going to be the next place to get the greatest capital growth. Join him in the studio, Steve Ash. He's the founder. We've had him on before a couple of times of Property Strats, and most of our discussions have been largely around portfolio construction. He comes from a funds management background, and he's been leveraging the work that he's been doing in those areas for many years in relation to building out a portfolio, a property portfolio, using all of those logic and also systems and processes that you would do in relation to building out a fund or portfolio construction for an advisor. Today we're actually going to get a bit more tactical and technical, create a bit of a blueprint for how you can actually identify those markets. Hot tip, you don't have to use a buyer's agent to do this. Most Australians still do it themselves. You might not think that if you tune in the property podcast. You think every man and his dog is using a buyer's agent, but the bulk of most transactions for property investors are still done individually without buyer's agents. So I'm going to use this opportunity to pick Steve's brain, try and get all the secret sauce. So if you want to go and do it yourself, it's all there. And one of the great things about property and property investment is all the data points and everything that you need to know is largely available and also largely free if you know where to go and get it. Steve, how you going? Welcome back.
Yeah, no, it's good to be back, and just before Christmas as well. And I think, Smart Property Investment Show, I remember sort of what I was when I was in corporate, taking a bit of time. That's generally what I used to sort of binge, sort of listen to all your pods and get all my knowledge and sort of work out my strategies and stuff. So, yeah.
And now you make a living out of it. So that's all my OIP you've nicked, is it?
Well, it is. I owe you a check. So maybe. There you go. It's coming in the post.
You can have it. That's why we do it. We want to sort of democratize information when it comes to property investment, and still the reason why we set up this podcast and Smart Property Investment originally was to help people be more informed. In many ways, you are swimming with sharks when you're operating in around property. It's not only on the buy side, it's on the sell side, and around some of the advisors that people are using. I'd say you're certainly swimming with sharks these days. So, buyer beware.
Well, it is. Not to start off on too negative a tone, but you do have to be careful. There are a lot of bad stories recently, and there's a lot of I don't know if it's controversial to say. I know you talk to a lot of buyers, you talk to a lot of successful investors, but I'm starting to think there's a little bit of a kind of rhetoric towards buying quite remote regional sort of plays and almost treating them like penny stocks, if you will. And, and it's not supposed to be negative. I think, I do know as a property investor, you've got to be a risk risk manager of your own portfolio. And I get the feeling like, you talked about rates not going down anymore. If anyway, there's going to be an upward trajectory for them. But I do get the feeling there could be some sort of black swan type event that comes in. The GFC was 20 years ago or so. I mean, that's crazy. But so I think, if you're looking at a portfolio and you're looking at affordable and those good areas, I think that's very important to be cognizant of, because I don't know. It'd be interesting to sort of throw that question back to you, whether you think there could be something maybe in the next few years where there could be some sort of event. It feels to me, thinking about the Warren Buffett, there's a lot of greedy people, a lot of people looking at property out there. So in my small mind, I'm thinking that's the time to be a bit fearful.
Yeah, absolutely. I've been on the record and quite vocal about my views and opinions towards the way in which Australians are considering property as a investment vehicle and the type of people who are becoming attracted to the property investment industry as a profession. So we've had, a proliferation of buyers agents entering this space, and essentially they're just on social media, all pretty much saying exactly the same things, and a lot of it is very, very dangerous. I'd be very, very careful who you choose as an advisor when it comes to property investment, because it's turned into a bit of an internet meme in some ways where, 20 years ago, 15 years ago, the buyer's agent cohort was a small group of very focused professionals who were very diligent. Now it's like, who can say the most extreme thing on social media to try and get someone to give them money because they're doing a side hustle, selling property on the side because they're doing another job. That's the way the industry is heading, and I think it's quite concerning and alarming.
It is, and I've seen the videos, and I've just made 100,000 in this in 3 months in this particular town with a decent cash flow. All the kind of unicorn deals that you might sort of look to find, say, in a major metro area, and it's there's big hooks to it, and it's big industry and people making lots of money out of it, and you do feel that. With the proliferation of this, to your point, that there's going to be something sort of coming. It feels a little bit like the thrifts maybe in that 2007, 2008 with the subprime in America. You just got to look at where the money and where the people are sort of getting rich, and it's not like the old cohort sort of having a go. It's just common sense.
Oh, absolutely. And you talk about a black swan event, and for those people who aren't familiar with a black swan event, it's essentially something happens which is completely out of left field that no one really planned for. But yes, there will be. We're going to mark 6 years since the COVID pandemic in March, April of next year. Right? Yeah. That was a black swan event.
That was.
And I looked to my portfolio during that period of time. It was largely bulletproof. I had no concerns or issues around it, even though some of the major banks were coming out saying, "Hey, property prices may reduce by 40%." Right? Really? I was like, "Hey, now's a good time to buy," because the inherent value of property. And if you go back and listen to those podcasts, we stood the course from the absolute day when sort of COVID emerged, pretty much saying, "Hey, this is what's going to happen. This is how it's going to play out." We're largely right. So, Australia's property market can weather these black swan events, but not all portfolios will weather these black swan events. And I think some of the challenge you have right now is that some of the portfolios that are being constructed and created by people using maybe some fringe type sort of orientations around, dubious lending and trust-based stuff that's all happening, and having friendly accountants that can write your letters and stuff. Like when the balloon goes up and there is a problem and there's challenges, that's when to Warren Buffett, you're going to see who's been swimming naked, right? When fear and greed, there's certainly a lot of fear when those things take place, but it's the greedy people that get found out. And I'm not going to have a position on whether or not you should be buying affordable properties in regional towns. That's outside my pay grade. It's not what I do for a living. But what I would say to that is that you want your portfolio to be constructed in ways that it's bulletproof, irrespective of the situation. And a bulletproof property portfolio is something that, despite any black swan events, you don't need to sell. That's a real simple way to do it. If you just go, because you look at the reversion to the mean, you're a finance guy, even in these black swan events, or you see sort of seismic shifts to the economy that have some implication on property markets, that the property goes up and down, but when it bounces back up, it normally bounces up faster and past where it sort of started. So you just want to be able to hold the course. That's the key.
No, absolutely. And I think your comment about a bulletproof portfolio and having maybe sort of, dry powder, cash reserves like you were able to make advantage of that good COVID event is critical. And we've got to look to history to sort of see how this has played out. And I always think about that sort of, and it's kind of, there are some similarities, and you know this better than me with the magazine stuff, or with the mining boom and some of these areas like Gladstone, etc. Not to pick a few, and I still talk to my accountant. He talks about the people buying at the top of the market. Then it was on all of them. It is in some of the other publications. Investors of the Year, buying Port Hedland, Moranbah, these type of places is probably the closest precedent, I think, but not strictly, because there are in some of the regional areas a little bit some differences. But if you time that wrong, and the market does come out, there is a type of event, then you're going to be paying for that. And so having a bulletproof portfolio, so important, getting in the right areas at the right time. I mean, I mean, investing's boring.
It should be.
It should be incredible. And even if you just stick to like the Brisbane, Sydney, Melbourne, like the Adelaide, the key sort of metro areas, at least you can sleep at night, and you're not going to be potentially struck down with the volatility that comes with these other markets.
Yeah, you think about all those mining towns, and what you had was greedy people chasing, off the chart yields in these mining towns. A moment in time through the mining cycle where a lot of stuff was getting built. Therefore, you needed to house a lot of people in these regional towns, single economy towns, mining towns. Moranbah, Port Hedland, places like this. The people that won there are the ones that got in easy, and like there is now, there was similar dynamics there where people were pumping up these suburbs. Back then they were called property spruikers, right? That you'd go to a seminar and they'd get a whole bunch of people in a room and pump them up on how you can become a squillionaire overnight. Quick, go behind, up the back, sign up now. We get you hooked up with something. Exactly the same thing's happening today. It's just happening to different guys. They're leveraging social media and other mechanisms, forums and groups and all this sort of stuff. Same thing's happening today. Who's benefiting from all these type of things, right? And typically, it's not the property investor.
No, it's
don't
not.
Want to be in a city, don't want to talk it down, but someone needs to be the voice of neutrality here because I'm probably one of the very few people who is unaligned.
No, and I think it's great that you're actually calling this out because it is. I mean, it's critical. I mean, everyone knows the story of Jordan Belfort, The Wolf of Wall Street.
Yeah.
And working at security houses back in the day, the high touch comms were pretty good, and the further you go back and the less technology, they were bigger and bigger. But I mean, it's there are parallels where you've got like Stratton, for example, like with the IPO listings, which could be AKA, the kind of place in the middle of nowhere. They've maybe brought a few, and then the championing comes on, which the platform, which is the sales guys on the call, pumping them up. And then there might be some exiting of that. I think morally it's wrong. There's local people who live in these areas or whatever, and you're manipulating those particular markets. I don't want to sound like an old fuddy-duddy, but you can still. I don't going back to the fundamentals and talking. Even with to take the old Jan Summers, going back the old sort of building welfare residential property and just looking at kind of, slow and steady, etc., and portfolio growth and getting to those sort of goals. I think sometimes we're losing sight of the key concept.
Slow and steady is good, and that's how you create real wealth through slow and steady. And there will be a point in time when something happens and all that is happening right now will some people come unraveled and some people find themselves in challenging situations. There is still people now, 15 years later, since everyone with the heady days of investing in these mining towns, who are still carrying significant debt against properties which aren't worth.
Yeah,
they're not worth the debt that they have on them. They're in significant negative equity, and they can't offload it because they've got to find the difference. So they're just holding on, scraping along, and it's holding them back. So, these are the consequences, second, third, fourth order impacts of making poor decision making. Now, I don't want to sound like property investment is dire. It's a good place if you're aware and engaged and connected and you've got the right people to still create long-term wealth. But you've got to be very conscious of the environment that you're operating within.
No, you do. And if we think about some of those Port Hedland type deals, I think it was about 700k purchases with like 1,500, 2,000 a week, so 12, 13% yields or whatever it was. Yeah. And now the same sort of deals are like 4 to 5% yields. I mean, it makes it.
They'd be lucky if they're worth a couple of $100,000, $300,000, right? And I feel for all those people who made those calls. So back to the point, one of the reasons why around democratizing information through something like this is that there's less excuses today than what there was maybe 15, 20 years ago to not be as informed and educated. If you want to know, you can go out there and you can create whatever frame of reference you want around property investment depending on where you absorb your information. So I like to think Smart Property Investment Show is a source of, as much as we know truth and accuracy. I don't have a particular view either way other than make sure you're getting the right information in order to support your decision making, and that's what it is. But sound like doomsday merchants. But
no.
There will be another black swan event down there, and for people who are prepared, it's going to mean opportunity. For people who aren't, it's going to mean maybe consequence.
It does. It's just but it's not called out enough, and that's why I wanted just to talk about it. And I know it's topic close to your heart, so. it's good to call it out. I mean, there's still opportunity around, and but it's very important to think about that portfolio just to ensure that you are bulletproof, and when we go through these events, that you're protected. But I think,
and this comes back to your point around portfolio construction. What's the best portfolio? Is one that's constructed which is largely bulletproof, and that's a concept. I don't want to be the guy who said I told you so, but I've been telling so now for many years around how to go about doing this properly, and if this industry, this property investment advice industry, doesn't self-regulate, because it's not regulated yet under any sort of true governing body, so it needs to self-regulate, and it's not self-regulating at the moment. It's going through its birth still. It's still trying to find its way and understand what it is and how it looks. But if it doesn't self-regulate, it will be regulated, and already you're seeing in the wings not self-regulation through the advisors themselves, but lenders. Macquarie Bank coming out and sort of, canning lending in trust is a clear indication of, hang on, there's certain cohorts or aspects of this industry that aren't too happy with the way in which some of the advice is being promoted and supported. And pretty much saying, trusts have been hijacked in many ways as inappropriately as a vehicle to get around potentially serviceability requirements, and a lot of these ideas have been peddled by certain aspects of the industry, and it's getting policed, regulated before APRA or some other regulatory body comes in and stops it. So who knows? But there will be at some point in time, if and when things go wrong, I think there's going to be a big review of this industry within 5 to 10 years, and there's going to be a lot of question marks around it. And when it is regulated, and I think it should be regulated, however that happens, I don't know, it's going to be over-regulated. So,
and I think that's a good thing. We saw it a little bit, obviously, with the Royal Commission and some of the funds back then, and a lot of I saw it, seeing what the compliance guys had to go through. I always remember at the funds there was just a couple of compliance by the end of the year when we had the Royal Commission. There's about 12 or so people in the team, and so I can clearly see something like this will come in. And I think it's needed because, especially with self-managed super funds or some of the. It is veering on advice on what people are getting for people. And this is I love super in the UK. I wish we had a better system like Australia, and having worked for the super funds, and this is just critical for people's wealth. If people do want to use super fund, they've just got to get the right advice. And so I think regulation coming in will help the industry. And I think if you're doing it, there's a lot of people doing the right thing by their clients. And if you are doing the right thing, then you've got nothing to worry about.
Look, everyone should be operating under a code of conduct. There should be a moral and ethical foundation for how the property investment advice operates. To be fair, over decades, it's attracted, some sharks, and that's going to continue. So absolutely buyer beware. But a hot tip is that when governments start regulating stuff, they typically will over-regulate it, and the Australian government particularly likes to over-regulate stuff. So it's the last thing you really want to happen. And when you get the boffins term of endearment down in Canberra sort of making the rules around stuff, whether it's policy development, it's when things often also go wrong. They don't always get it right. And you only need to think about some of the policies created recently, like this 5% sort of deposit scheme. Like that's going to come back and bite the government in the backside. And again, I don't want to say I told you so, but I've been telling you so for a long time. And whoever conceptualized that,
real time on that. I mean, that really has, as you know, like it's been tinderwood to the property space. I was just looking at some of the sold prices in Brizzy. Absolutely incredible. Like all that market up to 1 million, just absolutely on fire at the moment. And Melbourne, we've seen move, and Sydney, certain units. I mean, I think if you're buying a property around a $600,000 mark in any of these states, it's almost just I think it's about $30,000 to close a deal. Because no stamps, etc. There's concessional stamp duty when you go past 600. But it has so while you've had this sort of move in inflation and no more kind of rate decreases, you've got this other sort of policy that's igniting the market.
I don't understand it, and I don't want to be critical. I like the idea of developing smart policy to support an outcome, and I think the intent was right, but the execution is wrong. But when it's introduced as an election promise, pretty much go, hey, we're going to do this. How many votes did it buy the government? Who knows, right? But They're coming out saying, no, we've done treasury modelling, and treasury modelling says there's only going to be a very, very, very small increase in property prices over, I can't remember exactly what it was, a 5 or 6 year period.
Yeah.
And every single economist went, nah. Like even every high school economics kid is going to just go, nah, that's not the way it works. So anyway, this is what happens if let's try and get it right ourselves. Is the point. And to all the investors out there, the accountability and responsibility of your portfolio is yourself. So if you make the wrong decisions, that's your accountability in your decision making. You can't point the fingers and blame. You need to make the call about where you're taking advice from. You need to make the call about how much you choose to invest. You need to make a call about the strength of your family balance sheet to buttress any changes in lending and or family circumstances. You're accountable and you're responsible. So buyer beware. It's tough out there.
It is.
But we're not here to talk about that today.
No.
Set us up. So what sort of is sort of connected? I want to sort of get a bit tactical and technical, sort of how do you actually create a blueprint? So we talk about portfolio construction, all the reasons why. A bulletproof portfolio is one of the things, but how do you actually go and get stuck into that? We're going to get into that. We'll go to a quick break. So with us back in a moment. Welcome back, Phil Tarrant, having a chat with Steve Ash, founder over at Property Strats. Now, Steve, so we've done the philosophical stuff and the strategic stuff. And you go, that's great, that's nice.
Yeah.
And you can talk about that still to the cows come home. But the rubber's got to hit the road at some point, and the only way you can actually build a portfolio is to buy properties and
take action.
Again, unfortunately, most of the information around property investment is around the buying bit. You only buy a property once. You manage it typically for a long period of time. So more emphasis needs to be based on the management and how you leverage it. But we're talking about today how to find the right property to build out a good portfolio. Now, again, everyone's different. There's going to be different strategies for everyone, et cetera, et cetera. And by no ways we're providing any advice here whatsoever. But we'll talk in general terms. The key thing is, there's, I don't know how many, 10,000 suburbs or something in Australia. I don't know. You probably got to know. It's 11,000.
Yeah,
there's a number
about
around.
right. How'd you find the right ones?
Yeah. I reckon I could be one of the biggest peddlers of misinformation in property investment because I sit there and I just go, I think there's about 10,000 properties. I'm sure someone knows the actual number, but there's a lot, right? So how do you actually go about identifying sort of market cycles at macro levels to actually sort of orientate yourself around before you get to a suburb level, the right time to buy?
Yeah, and it's a good comment, and I kind of bring it back to sort of what the concept I've learned in banking and the value investing sort of principles. And
so what's value investing? Maybe explain that to us.
So value investing is the kind of coined by, I suppose, Warren Buffett's of the most obvious kind of proponent of that, but it came from someone called Benjamin Graham, who wrote The Intelligent Investor back in the day. You might even have it on your shelf. I'm not sure.
Yeah, I've read it.
You haven't? Yeah. Okay. So it's really trying to buy $1 for 50 cents and trying to buy, in this case, sort of companies or really good companies at really good prices and having that margin of safety going into the deal. And what I've tried to do with property is do the same thing with with houses and markets as well. So I've looked around, as you talked about, like properties do move in cycles. So we're always kind of cognizant. There's been the property clock. I think that's kind of how it's termed in some sort of way, but it's just common sense way of saying the same sort of thing. So we're looking for those markets that haven't outperformed over the last few years, but are kind of almost like your blue chip stock or suburb type plays. So if we kind of look over the last 5-7 years, you're talking about COVID before. Clearly, Brisbane, Adelaide, then more recently Perth have performed really well. Obviously, the regions have done well, which we touched on before. And so, from a contrarian point of view, I try and keep it as simple as possible. I think there's a lot of data, data Roonies or whatever you want to call them, out there now. But it doesn't have to be rocket science. You can just look at the areas, and you can see there's a few markets out there which have extreme value where you can build a bulletproof portfolio to use your term and steal that for a second. Where
you can have that, by the way.
Oh, thank you. Yeah. It's going on to the marketing after this.
There you
go. I love it. Where there has been a slight increase now, and we know there's markets within the market. So with rates previously, look, they were going to come down, they're going to stay stagnant, go up potentially now. But the moment the value is really in Sydney, Melbourne is what I see. There's a few other areas, but I'd be focusing on there. And with them, you've got different assets. You've got houses, townhouses, units, and you're really looking for value those areas that are affordable. So it's almost a three-tiered approach. I look to actually find the deals, and the first level is that macro level, what you're talking about, and looking at those two areas. And I try not to overthink it too much. It was plain as day 10 years ago, for example. Brisbane was really undervalued. It just took a while for the value to come. Like a lot of us were waiting 4 or 5 years, which it's just part of investing. And but here, Melbourne and Sydney, those would be the two areas I'd be looking in. And then from there, I'd be looking at another sort of like layer of analysis and trying to find those undervalued areas and undervalued assets within there. And when I look at sort of price disparity, we've covered it on another podcast. Like Melbourne is still trading at, back in January, it was 41% discount to Sydney. So clearly, like you're talking mean reversion, there's going to be opportunities in there. And then it's going into Melbourne and just kind of looking at those areas where you can see a bit of value. There can be a little bit of data analysis in there, but you can also just pick up the phone and it's quite easy to work out sort of supply-demand imbalances just by talking to agents.
And that's at a macro level, and you can absorb yourself with intricacies of numbers. What you're talking about here is a little bit simpler, and it's pretty much, comparative analysis of similar markets which have pricing disparity between them. And the fact that the Melbourne median, and maybe this number has changed recently, but, up until 6 months ago or so, Melbourne was after Sydney. It was after Sydney, Brisbane, Perth, and Adelaide. It was the fifth median price. So you sit there and you just go, well, that sort of doesn't make sense, right?
No.
And this is the simplicity of it. At macro level, you can get right in there and just go, that doesn't make sense. It's Australia's second biggest city, if not its biggest city, and it will be much bigger than Sydney into the future. So why is it trading at such a discount to all those other markets when largely it should be trading, and historically has traded a lot closer to it? So that's a clue, right? So is this what you're looking for at a macro level, just clues for something doesn't seem right? It's like Sesame Street, right? Which one of these don't belong together? Oh, it's that one there. There's something wrong. Let me interrogate that a little bit more. That's sort of macro level stuff.
That's a good point. I'm going to steal that one as well.
Do you remember the song?
I do.
Which one of these don't belong together? Which one of these all the same? Like one of these things is doing its own thing, right? But that one there.
It is almost that simple. So if you have I love this one. Like if you've got a graph of a chart, and you give that to sort of like a 7-8-year-old kid, and you go, what way is it going? It's going up.
Yeah.
So you want to buy with the trend. I mean, it's just as easy to identify that. It's the same sort of thing here. And then going back to that sort of like concept of value investing, I think Mr. Market, who's this schizophrenic sort of character who sometimes really has a bad day and really undervalues something, and sometimes he gets ecstatic about something and really overvalues something. Here, Mr. Market is really pretty negative on the likes of Melbourne, on the likes of units in capital cities, and so with that presents a bit of opportunity if someone has the stomach to do something like that. And no one said that investing's easy. I mean, the concepts are simple, but when you're trying to zig when everyone else is zagging and buying in, as we talked about at the start of the episode, and chasing that 100,000 growth in God knows where, that's when it becomes quite a tough thing to do. And
is it a reasonable basis for decision making? No, pretty much going, well, Melbourne should be trading higher than what it is comparative to these other markets, and baselining it potentially historically how it's traded against Sydney and these other capitals. Is that enough to justify investing now? Because there's still some fundamental issues in Victoria which is shaping and probably a catalyst for the reason why the market isn't trading at the rate or the price it should be trading is comparatively.
No, it is a good point. There's a number of economic reasons why it's happening this way, and but I still think that sort of contrarian outlook on things, and again buying houses at close to land value, but then looking at the long term growth rate, and I think I'm going to get this wrong, but when I looked at PropTrack data, like the long term growth rate of all capital cities around 5.7% annualized over the last 30 years. And Melbourne is around that 5.9. It actually surprised me.
I think Melbourne outperformed. I think I know this data. I think Melbourne slightly outperformed the other.
It did.
Other capitals on a much longer term basis.
Yeah, it did. It did, and when we look at what it's done over the last 7 or 8 years, not too much, but in the last year, it definitely has moved a little bit. I don't have the numbers right to hand. I think you're going to help me out here. I'm going to phone a friend.
Yeah.
There's certainly markets within Melbourne which have performed extremely well, and but it's a good point you make. Like it being contrarian, like where you're going to be, but if the numbers are stacking up on the deals, I think, and there's opportunity to keep buying, that's kind of how I look at it.
Yeah, and it's also a bit of a time and a waiting game. Now, I think, and I've been on the record with this comment beforehand, I think a lot of the activity in the Melbourne market is being driven by property investors and buyers agents, right? It's where everyone's operating at the moment, and certain pockets of that, and that's on the basis that maybe the inherent drivers outside of just demand isn't enough to satisfy the growth that's taking place right now. And that's a bit of a sort of contrarian view. And I've spoken to some buyers agents that would certainly echo those sentiments. In many ways, I'm just repeating what they're saying because I don't particularly have a view. So that's one point. And you go, okay, well, fine. You may as well be on that sort of upward trajectory. But something functionally needs to happen in Victoria in order for the real inherent drivers of growth to emerge and sustain. Because if Melbourne has grown comparatively at a sort of more favourable rate than other capital cities, there's got to be something in there at some point in time. So what needs to happen to actually shift the Melbourne market? Who knows? Like they're spending their money on machete bins, to try and solve crime at the moment. And if you want a real insight into whether or not you got the right people in charge there making decisions that is going to actually support the economic growth and integrity of Victoria moving forward, maybe there's a bit of a clue there. And, that's got to be a polarising comment that some people are going to be annoyed with. But there's still not the inherent drivers there. There's still a malaise in the Victorian Melbourne market running off the back of COVID. A lot of decisions that were made during that period of time. And you speak to most people out of Victorian Melbourne in particular, would be like, yeah, it's still a long way off. But the point is that we're looking at macro factors that would indicate it. So, there's probably a reason why most people are down. Most buyers agents are down there. Well,
yeah, I think it's extremely hard with the macroeconomic levels to see what's going to be the driver that really tips it off. I mean, I look at it quite simply, and I think Melbourne's just becoming extremely affordable for people. And what we saw with Brizzy back in 2018-19, big migration. Obviously, COVID then hit, and there were reasons. I think it was the world's longest lockdown in Melbourne.
Yeah.
And people left that, but then all of a sudden, Brisbane was really affordable. You could get 4-bed, 2-bathroom houses on decent plots of land at 600,000-700,000 in decent areas, decent schools.
Genuine structural drivers, right?
Yeah.
As well as livability and affordability, everything connected in with it, right?
Yeah.
So I've got concerns about the Melbourne market. To be fair, I'm looking to buy there myself at the moment because I'm sure there's going to be some upside drivers. But you've got to choose somewhere, right? So you've got to look for these clues about which is going to help orientate you in the right way. So directionally, you're going in the right place. Then you've got to get into the weeds and do the other bits. So, but you're saying Sydney. Sydney looking all right for you at the moment?
Yeah,
the Sydney market.
I do like Sydney. I just cover one of the comments you talked about with Melbourne, and I think you're dead right. And I think there's definitely some suburbs where buyers agents and investors and people who follow courses, it is a factor. And if you look in the west of Melbourne, you can certainly see that sort of apparent in the likes of Werribee Hoppers. But in some other areas which are kind of more higher owner-occupied sort of areas where we're looking maybe 80% owner-occupiers in that area. Throughout the year, it's really been home buyers who've driven those sort of markets. And those are the markets you want to be in if you're going to have that sort of bulletproof type portfolio. And if we look at sort of Sydney, especially with the kind of incentives that you just talked about, certain some areas are looking pretty good, pretty undervalued. And even when I look at house prices in Brisbane compared to sort of Sydney, I'm not suggesting people go out and buy them. They're starting to look pretty good value in some sort of areas. But those attached dwellings, those units, I've talked about it quite a few times now. I mean, they're so cheap and they're great for the portfolio.
Yeah, I think, when you look at value investing, again, there's certainly pricing disparity between houses and units, which when you just got to look at a graph and go, yeah, something's sort of not correlating anymore. It used to sort of move in a pretty consistent fashion, but now the gap between houses and units in Sydney specifically is really growing out, and it still really hasn't remedied. And you go, well, there's something in that somewhere, and a lot of people have been conditioned not to. They go, don't invest in units. Units don't grow in value. It's the land value that grows in. Building out a portfolio, often units can make sense in the right way.
Well, they do. Going back to the sort of mean reversion that you were talking about, Sydney units, I think they're trading at a 68% discount to the house prices.
Yeah.
And in some suburbs, it's even more. And if you bring in the incentives and you can actually, you've got up to 600,000. I mean, you can get quite close to CBD. These areas are changing quite a lot, and there is starting to become a bit of a supply demand imbalance. I think.
What's the cap on that 5% in New South Wales or Sydney? It's like 1.5, is it something?
It's 1.5, but there's tiers to it. So I think it's up to 600,000. There's units. No stamp duty and 5% deposit. And what you're finding, like in some of these Western Sydney areas, where you can still pick up units in the low 4s to sort of mid 5s, like those kind of markets are quite hot in those.
I sold a unit in Mount Druitt.
The Drury.
This year.
There we go.
This year?
Mm.
Maybe it was this year. Like 300 something grand.
300 grand?
300 and something. Yeah, I can't remember. 340 maybe.
What did you buy that for?
Like 100 and something.
100?
180 maybe, 170.
Yeah.
But it was literally opposite the road from Westfields. 2-bedroom, 1 bath, car spot. You cut garage, 300, maybe 340, 350. I can't remember exactly what it was.
There you go.
It's affordable.
It's very affordable.
You're in that for 5%.
So,
5%.
You're talking about bulletproof portfolio. One of the most important things is being able to hold that portfolio and let time do its thing.
Yeah.
And so these areas, I think COVID kind of misrepresented sort of like the market a little bit. A lot of people moved out, commuting in 2 days a week, and sort of that's obviously exacerbated the problem with units. But if we do have this type of event that we were talking about a second ago, and unemployment does come up in some of the regions, I think the regions will have a hard time, and there'll be a lot more movement back to the major centres. I think that's just part of the cycle.
Yeah.
And then affordable properties, and if you do compare the Sydney units or Melbourne units compared to, say, the other areas, and particularly in Brizzy, Brizzy's trading at quite a big premium to them now. So I'm just all about looking for opportunity, looking for value plays, but then also for the portfolio construction point of view, it just makes it easier to build that sort of portfolio value.
Yeah. So looking at these macro level indicators or factors, so then you actually got to zoom in to find the right suburb. You got to identify them and do something about it. So you give us some specifics there, but sort of structurally, how would you go about doing that? So you do this for a living, so probably a lot of it is innate and inherent. But if someone goes, all right, I've made a decision, I'm going to invest in the Sydney market, right? So you're probably going to be dictated by your budget, I would imagine.
Of course.
It's probably how much have I got to spend, and therefore what suburbs and which areas are most attractive, and that may also indicate whether or not you're buying houses or units. But what would you sort of then do in order to get down to a suburb level?
Yeah, well, yeah. So if the price, and if we're taking Sydney units or whether it be Melbourne houses, we're looking at those kind of areas where there is a bit of gentrification play happening. It could just be going to the area, just talking to people in the suburb, getting an idea in the bars exactly what's changing, seeing new cafes coming up, etc. Talking to agents, seeing if there's a bit of a supply-demand imbalance. I mean, I'm quite fond of the owner-occupier ratio. If we're looking at units, obviously they're going to be heavily skewed towards investors. So that kind of metric is more for houses, take in Melbourne, where you might be looking at more 80% sort of owner-occupiers to sort of zero in on a sort of suburb, starting to see days on market start to track down a little bit. And then just going to open homes, just seeing how many people, how many groups is seeing through. I mean, I've got this little thing where, particularly, and this is why I know within Melbourne that it wasn't all buyers agents moving markets, because you can spot a buyer's agent pretty quickly at an open home, I think, and then you can actually
How do you spot a buyer's agent at an open home?
They've generally got a phone like that, just looking around.
Yeah.
And they got the white trainers on like I've got today or whatever. I'm going to just throw myself under the bus here.
Yeah, there you go.
But you can spot. But I mean, it's just as easy to spot the owner-occupiers, obviously, just looking around, seeing the questions they're asking, et cetera, et cetera. And certainly in the likes of Frankston, Seaford, it was heavily those kind of demographic, with Narrow Warren, an area which we can talk about is another area where we're seeing that in. But with the unit plays, just looking at that, like it is mostly owner occupiers just going, like young first home buyers going into these.
But that's who you're competing against if you're an investor. When you consider the price points where largely most investors play, at least people who are maybe new to investing, they're going to be, and this is this sort of tinder that's been put onto the property markets. Property investors already quite active in these markets, and it's just been exacerbated by the fact that you've got all these first-home buyers with needing 5% deposits. So it's just a condensed cluster of a lot of demand for specific properties, and you can spot a first-home buyer pretty quickly also. They've typically got mum and dad along sort of giving advice and recommendations. So, orientating yourself from a macro point of view to give you clues where you should be investing, and then narrowing down into a suburb level. It's going to be price dependent, some of those other areas. But then it still comes down to the deal. Not all deals are created equal, and knowing whether or not it's a good deal is often that's part of the craft of being a buyer's agent. And
it is.
There's a lot of unknowns, a lot of things you don't see unless you know what to look for. So let's have a chat about that. We'll just go to a quick break. Stay with us, back in a moment. Welcome back, Phil Tarrant, Smart Property Investment with Steve Ash over at Property Strats. Now, you found the right location, the right region. You're buying a house or a unit. You know what suburb you want to be investing in. You know all that sort of stuff. Then it comes down to the buying, right? You can only buy what's available for sale.
Yeah.
And or you can score yourself an off-market deal, which is not for sale, but someone's found it, so someone's willing to sell. So you can only buy what is for sale. So whether it's off-market or not, it's either for sale or not for sale. So, maybe you can go real hardcore and get someone to door knock, places to see whether or not they're willing to sell. And that's what real estate agents do. That's their job, is to try and get listings, right? Yep. So when you get down to that level of actually selecting the right deal and how you spot value, what do you look for?
Yeah, it's a good question. You just mentioned about off markets. In fact, just going up to the other level, if you are calling an agent and you're trying to got any off markets, that's the funny one. Like a lot of the agents I speak to, they get frustrated with people just got any off markets. But if they don't, and if there's no need for the agent to put that out there, then you can see that with the days on market maybe trending down, that maybe this is an area to sort of watch at the kind of it's popular owner occupiers and people want to be there. There's no need for someone to go and sell a property off market because they want to get, at the end of the day, they want to get the best price they can. Yeah. So it's a bit of a hat tip to say that this is a decent area to look in. Now, if you want to find the best asset, I mean, there's always going to be a bit of a prospecting sort of element to it. And if you're in that particular area, pounding the pavements to see what's going on. But probably the easiest way to do it is just to get a real good idea of what the comparable properties are in the area. Like obviously buyers agents use RP data, like sales agents obviously do as well. But you can just do this on realestate.com. You can just go, let's just say you're looking for, 3-bed, 1-bathroom house. You can just go in, zero in, have a look at kind of what roughly is sold in the last month or so, and then see if you can find a deal where you can potentially buy at that sort of price or maybe under with a bit of value add potential. And it does take a bit of doing, but that's kind of that's the way to do it. And the other thing is obviously driving around the areas, looking where the amenities are, what the nice streets are, tree line areas, and you can actually, there's a few data platforms where you can get an idea where the owner occupiers maybe kind of flock to in that particular area, where the social housing areas are, and where maybe to stay away from. So there's a number of things you can do, but I'd be looking at sort of realestate.com and just having a look and getting a real idea of where the value sits. Yeah,
and value is often a unique thing. One person may see value in a particular property, whereas some people may see liabilities in that particular property. It depends on what you're looking to achieve. Now, yes, there is sometimes some outliers, but everyone buys a property at market value. What is a property worth is what it's sold for. Really, really simple. And you can package it up any way you want, saying, I reckon I've got that $20,000 under market value. You go, well, okay, prove it. How's that? Oh, because the property next door sold for $20,000 more. And you go, okay, what were the circumstances of the deal? What were the properties like? Blah, 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 blah.
Yeah.
You bought it for what it's worth. Now, one of the biggest myths that need to be dispelled as property investors is that you probably should just pay fair market value for a property. Because that's what you're going to be buying the property at fair market value or market value. And that's what the number is on the contract. What's happened is that property investors have been conditioned on this idea of that you make your money on your way in. Well, you do if you buy the optionality correctly on the way in, and or you've bought in an area with the inherent drivers which are going to show capital growth. Thinking that you've bought at $10,000-$20,000 under market rate, it largely becomes absolutely irrelevant. You might have bought it $20,000-$50,000 under market value, and it doesn't go up in value. So that sounds like a great buy, doesn't it? Right? So people get absorbed and obsessed with it, and also with off market stuff. Like, to your point, if I'm selling property, I don't need to sell it off market, like unless there is some level of extenuating circumstances that requires me to do it. Maybe I don't want my neighbour to know that I'm selling. Maybe, I'm going through some sort of debt issue. Maybe there's, what is it, the 4Ds, debt, divorce, death, and something else.
Can't help you out there.
Yeah. So there's got to be reasons why people sell stuff off market. Doesn't necessarily mean it's a good buy. But the idea being that if people were selling off market, you're buying off market, there's this perception that means there's distress. That means you're getting a discount of some sort, or you're getting some value there. Like, just there is not that many off market properties out there, and all the people who are out there saying bought off market. Yeah, I'm sure a real estate agent has his name on a contract somewhere to sell that property. That's not off market.
And you reset the market value once that sale goes through. You kind of reset the sort of value of the suburb anyway to some degree. And I think you've also got to. We talked about it again. Property is a long-term, wealth building sort of game, and we're thinking 10 to 20 year cycles going forward. So whether it's sort of 10,000, 5,000 in the grand scheme of things, it doesn't really make any difference.
No difference, really.
Is that exactly? So
to be fair though, I remember when I was buying maybe 15 years ago in the western suburbs of Sydney, I pulled out of auctions because it went $1,000 over the budget I had on it, right? And that's discipline. That's buying an auction setting is, you certainly know what fair market value is, because you should have competitive tension actually determine what that market value is. So, the recommendation to everyone, just don't get absorbed or obsessed by off market. It's a true off market is, hey, I've got these two properties next door. I really want to try and buy next door. I don't really want them to know I want to buy it. I'll try and get an agent potentially to go and door knock it and see if they can do a deal. Yeah. Like, that's when you start getting in the realm of real strategic off market. But, an agent going, and this is again one of the, I don't want to give away all the missiles, trade secrets of buyer's agent. A lot of real estate agents, they'll go and win a listing for whatever reason. What's the objective of the agent? They want to sell the property as quickly as possible for market value, right? So what's the easiest way to do it? Okay, let's go do a full, 2-3 week campaign. Let's spend all this money on social media. Let's spend all this money on advertising. Let's get the thing staged. Let's do blah, 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 blah. Or they can just call up a buyer's agent and just go, hey, I got this joint. I'm going to put it up on realestate.com in a week's time, but I'll give you first crack at it if you want to. So then the buyer's agent just becomes an agent of the real estate agent. And I don't want to be a cynic around that, but a lot of this stuff's packaged as off-market stuff. It's just really the agent going, I don't want to do all this work. I know this guy over here has got all these clients that want to buy in this area. I'll just give him a call and say, hey, mate, you got this for a day. First crack. I want a contract by the end of the day. That person will go out and do all the work for them, get a contract signed. Happy days. The agent's got the thing under contract, Yeah, absolutely. He gets his commission.
Absolutely.
I don't want to be a cynic, but it's the way it is.
Buyer's agent gets the sort of com for getting the deal across the line, and whether it's a good deal or not, that's up to the buyer's agent to sort of evaluate that. But it's a selling tactic, because then the buyer's agent can actually go and market that, off market. So they're definitely not all created equal, and definitely selling agents are kind of like cottoning onto this and using it as a bit of a sales tool.
If I was a real estate agent, I just have 10 or 15 buyer's agents on my Rolodex, if they still, and just go, I've got this place, and it's a big, you think about I don't know what percentage of deals now done, investment deals by buyer's agents, but, for your realestate.com and these marketing platforms, like, it's it's eroding that because you just don't need it. If you've got a ready group of buyers agents you just use as part of your selling arm.
Yeah.
Anyway.
Well, absolutely. And as an investor or as a buyer's agent, you're kind of cutting out a lot of your market. If you're looking at those areas that really have the value, which have the like it's called, data parameters that kind of make it sense to buy in 80%, and properties are transacting pretty quickly. There's no real need for a seller to actually put that to an off market. They're better off getting there. So it's your point as an investor to try and spot value, try and work out what's going to trade well. You obviously don't want to pay overs because then potentially that could be an issue when you come to do the valuation, and you might have to chip a bit more money going into the deal. So that's something to be cognizant of, and that's one of why
that's pretty forgiving now. There's so much data out there. You shouldn't need to overpay for a property. And again, it'll come down to market value. And as an investor buying stuff at market value, you do it all day long because what you're buying is the upside.
Yeah.
And a lot of people say, oh, that's not the way you do it. Well, off market might mean there's something wrong with it, or there's a lot of effort and energy and attention you need to put into it. Going, I bought this for $50,000 under market value, and when I do a $30,000 renovation on it, that's going to get me up to where the other properties are, and I've got to make myself $20,000. You go, okay, that's fine. You might want to do that. Put the time, energy, and effort into it.
Yeah,
but you got to put the work in.
Yeah,
you got to put the work in. You got to put time on that.
Yeah,
Yeah.
So no, call
anyway,
around. Build those relationships. Get in people's faces, etc. And largely, there's enough value out there, like just to spot in plain sight or whatever. And it could be like properties passing an auction, for example. You just go and call all those agents like the day after, and you might be able to get a good deal just by doing that because someone's then desperate to sell. They haven't sold it at auction.
But you got a price point. You know what it's passed in at,
yeah.
And then you've got a working pricing. You have a sensible negotiation around that. You've got an invested agent because the agent wants it off their books. The last thing agents want is aging properties that they can't sell.
Yeah.
Not good for them.
Yeah.
Like, part of their listing presentations when they go and win listings is, hey, my average time on market for my properties is X, right? And they want to outperform the market because they want to say, I'm a really good agent. They don't want them on their books. They want to get shot of it. So, these are all the specific tactics around it. But let's just sort of go in one more area. So we started at the macro level and then looking at the right deal, the particular suburbs and the right sort of deal and be comfortable with the idea of paying what a property is worth rather than try and get discounts or bargains. They don't really exist. Every now and then, you might get one or two absolute crackers, over the course of a lifetime investing, but most of the time, if you're doing it well, you're paying for market value. So can you give us a real-time example on how you would do this in a real area?
Yeah, sure. So I think, again, using the three-tiered approach and some great insights there. So again, if I look at this and I'm wanting to buy a house, for example, it could be, even if it is you wanted an owner-occupier, you want to get into a decent area and you just want to get maybe slightly ahead of the game and maybe not sort of emotionally attached to going and living in Tarrant in Melbourne, for example, if you're a squillionaire or whatever. But looking, again, just taking from a macro level, we know Melbourne's pretty undervalued. So obviously looking at Melbourne for that tier one. Secondly, looking at sort of suburb data, I was talking about owner-occupier rates. So if we kind of put this into sort of real time, looking at areas, there's a really good suburb called Narre South. I always struggle with my R's a bit there, so that's always, I got that one quite well. So that's about 45k southeast of the CBD. Very popular owner-occupiers. The rate there's 82.3%. So you really want the owner-occupiers to be active in that area, and they're going to be sort of essentially sort of wanting to move there, live there over time, and they're going to be the area that sort of does bid the prices up as time goes on. The yield's fairly decent on there. The long-term growth rate's pretty good at 5.8%, not knocking the lights out, but pretty good. Vacancy rate's pretty tight there, 1.3%. So you obviously want to rent it out and see potentially a bit of rental growth going forward. There's been a bit of infrastructure growth in the area. So the Fountain Gate Shopping Centre, the train station upgrades, etc. So there's a little bit of infrastructure works in there. So that's just giving an example of a suburb where you can use sort of certain data metrics to sort of zero in on. So it's going to be it's a popular area with owner occupiers, and then finally looking for that good deal. We talked about off markets. Potentially, you don't need to look at those off markets. You need to move pretty quickly, find these particular deals. And so there was a a deal that we saw in Chatswood Drive, which is in a decent pocket of Narrow Warren. And these are areas where, as buyers agencies, we see quite a bit of value in at the moment, and you can actually go and do this in real time yourself. And here we saw a double-story property. It's not really the typical sort of investor property you'd see on your TikToks, like you're talking about. And we're able to sort of identify it's a 5x2 double-story for $850. It's pretty tired inside, needs a bit of love, and that's something you'd have to go and evaluate on what you need to do. This was on 31 Chatswood Drive. And then just on the road, sort of on the busier side, there was one at 48 Chatswood Drive that sold for $950. And that was, fully done. I mean, the kitchen, bathrooms were great, but you can see you're buying quite well there. You're buying in a good suburb, and that's an approach that you can use. And again, it could all have been done on realestate.com, all the data platforms out there to actually identify this particular suburb, and then it's just being, sort of a dog with a bone, just finding deals out there, making calls, etc., seeing what you can find. And we're not talking off markets here. It's just, data in plain sight. And this area has been going pretty good over the last year, and I think it's got a fair distance to run.
Yeah, I'm looking at the location now, and that's all. If you're not familiar with it, it's to the west of Dandenong, to the sort of to the east of Dandenong, and to the northeast of Frankston, where there's a whole bunch of people
close to Berwick as well.
Yeah,
some really good schools in that area. So
it's not really that far to the beach, really, to Mordialloc Beach either. Probably take half an hour. You forget how big that industrial area is in Dandenong South. Yeah,
no, it's
massive.
It's remarkable. And Dandenong's an interesting area. That's gentrifying quite a lot at the moment.
Yeah.
Like hipsters moving in there.
Mate,
it's something to look at.
When the hipster cafes come in and the dog grooming salons, it's key data points of what do the cocktail bars is typically a good indicator. But all right, that's good, Steve. Thanks, mate. Quite a lot there. Yeah,
there is. Yeah, we've gone all around the tracks there today. Yeah. So I'm really pleased we've had this chat, because I think it's something I know it's been in the back of your mind, certainly in mine. What I want to obviously come to do is add a bit of value and add maybe sort of go against maybe some of the general convention that's being sort of talked about out there at the moment. You talk to a lot more people than I do, obviously, but that's I think.
Well, I think you got to say it as it is, right? Like it's a good time to be a property investor, and fortunately, as property investors, you've got a raft of people who are there and should be in your corner to be supporting you, making the right decisions. And it comes down to how effectively you do that, how well you run your team in order to make the right decisions. And if you're confident that you're taking the right advice from the right people, you should be decisive in your investing journey.
Yeah.
You don't have to use all these professionals. You can do it all yourself.
Yeah.
And more people do than don't. Some of the advantages that you have in using buyer's agents is potentially, someone who's giving you the supporting mechanism to help you make those right informed decisions. So, don't get caught up in the hype, right? Sometimes it's just a kick in the backside. Sometimes I do.
That's it. I think we all do, and that's why it's great. And again, going back to those first few books, the old school teacher Jan Summers, in her spare time in Redcliffe, just got out there, had a go. Just when she had serviceability, she bought. Yeah,
one of the classic stories. That's how you do it. You build well slowly, and don't get too absorbed with the hacks and the I've got a secret formula how you can it's not hard.
Yeah,
it's really not hard. There's probably a whole bunch of buyers agents out there who probably hate me, but but I've been a big advocate for the buyer's agent industry. It's important to me that it continues to shape itself in the right way.
Yeah, you've just got to do as a buyer's agent, you've got fiduciary duty to your client. You've got to know your client. You've got to do the right thing. You've got to make sure they do the right thing, and you're there to help them take the action, because sometimes it is a bit overwhelming out there. But when I see all the data points, I always think of this, Renaissance Capital. I don't know if you've heard of them. Jim Simons, the quant trading firm, the man who solved the market in America.
Yeah.
And you think it took them 10, 15 years looking at hundreds of data points, the smartest nuclear physicists and mathematicians. And to do that, and you got someone like Benjamin Graham, Warren Buffett, Charlie Munger, just obviously very smart people, but using time on their side. And if you use time on your side with property investing, you get in the right markets at the right time. You get good quality assets and you maybe if you get in that, even if it's the 5% sort of growth per annum, yeah, you're gonna and you've got a long enough runway, you're gonna do very well.
You will do. It's good counsel, Steve. Thanks for coming in, mate. If people want to track you down, you haven't put your feet up yet for Christmas. You're still working hard.
I'd like to put my feet down. I'd like to go and play some golf, but I'm not doing any of that. I've been working 7 days a week. propertystrats.com.au. If you want to have a chat, just reach out, and more than happy to talk.
Got to find time for yourself, mate. It's important. 7 days a week's quite a lot.
Yeah, no, my body's a temple. That's what my old boss used to say, and I'm sort of forgetting that at the moment. But maybe after this, I'll find myself.
Yeah, it's good. Nice one.
Thanks.
Well, no, thanks, mate. Thanks for tuning in. Everyone, remember smartpropertyinvestment.com.au if you want to keep engaged, connected, what's going on any given day around property investment. That's where you'll find us. And please keep those reviews coming wherever you're tuning into this, whichever podcast player. This is our 10th year of recording the Smart Property Investment Show. And we should have more reviews than what we do. I don't ask for a lot, but if you can help me out with that, it'll be super appreciated. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.